Good morning and welcome back to another Money Not Math conversation. I'm Drew Erickson and it is October 28th, 2020 when I'm creating today's conversation. I hope everyone who's tuning in for either the video or podcast enjoys this conversation and is having a great day. So my goal with our conversation today is not to advocate for who you should vote for, but it is to review Joe Biden's tax plan, because I think it's important for us to understand how whenever the tax laws in our country change and how that can affect not only our businesses, our current income, but also how we should potentially be changing how we plan for our future retirement, or at least how it can affect our retirement planning. So today I am going to be reading and reacting to the article, Details and Analysis of Democratic Presidential Nominee Joe Biden's Tax Plan, from the taxfoundation.org. And it looks like it was written by Garrett Watson, Haquin Lee, and Taylor LaJoy. Hopefully I didn't mess up those names too bad. But getting into it, I'm not going to read through the whole article. It's pretty long. I'm just going to kind of highlight their key findings and react to some of them from my point of view. So the key findings from his tax plan is Joe Biden would enact a number of policies that would raise taxes on individuals with income above $400,000, including raising individual income, capital gains, and payroll taxes. And Biden would also raise taxes on corporations by raising the corporate income tax rate and imposing a corporate minimum book tax. Now, why is this portion important? Well, you know, for a lot of people don't make $400,000, and maybe you aren't thinking that will affect you. But one thing to be really aware of is if they raise capital gains tax rates from a maximum of 20% to the current income tax rate of what they will also be raising to, I think, 39%, which I'll get to later, that can have a huge effect on how you invest your money. All right, so if you invest your money in brokerage accounts, basically in mutual funds that aren't held within a 401k or an IRA, that any gains you have on those accounts will now be taxed at a higher rate. Instead of being a capital gains rate of about 20% maximum, it could be as high as the individual income tax rate maximum that your income is currently at, which can be significantly high, especially if you're making, $200,000 plus a year, or even if you're only making, $180,000 plus a year combined with your spouse. So even if you aren't making $400,000 a year, those tax changes can have a huge effect on how you build your wealth, or whether it's you're building your business, or you're selling real estate. Anything that creates a capital gains tax will have a significant increase in the amount of tax you owe when they raise that capital gains tax rate. And of course, if you're making over $400,000, all of those changes affect you. Hopefully it doesn't destroy your business and your ability to not only create income for your family, but also to pay your employees, because the last thing we ever want, and hopefully the administration understands that if he gets elected, is yes, taxes to pay for the government is important, but the last thing we ever want is for people to lose their jobs because business owners can no longer pay their employees. All right, so the second point they talk about is Biden's plan would raise tax revenue by $3.3 trillion over the next decade on a conventional basis. When accounting for macroeconomic feedback effects, the plan would collect about $2.8 trillion the next decade. This is lower than they originally estimated due to the revenue effects of the coronavirus pandemic and economic downturn and new tax credit proposals introduced by the Biden campaign. Now, I might not get into all of them, but it's really interesting because the Biden team wants to raise tax rates for both the individual and the corporation, but it also looks like they're introducing a bunch of new tax write-offs, or what's the word I'm looking for? Credits. They're introducing a lot of new tax credit options. So it'd be interesting to see how, with these companies who pay a lot of money to their tax planners, how much more they're actually going to end up paying in taxes. So according to the Tax Foundation's general equilibrium model, the Biden's tax plan would reduce GDP by 1.62% over the long term. That could be a huge deal. It only sounds like 1.62%, but when, as a country, right, if you look at our country as a business, which it's not technically a business, but from a budgeting standpoint, I sure wish they planned more like businesses, because our government, in my opinion, is absolutely terrible at managing money. Hence why they spend a significantly larger amount than they make. But if we look at their current GDP, Let's see, I'll pull up the US debt clock and I gotta find the GDP. Where is it? I apologize for the pause. All right, so the US gross domestic product, there it is. All right, so the US gross domestic product is currently 19 trillion dollar, 19.8 trillion dollars, right? And if you're a business, or even our country, you would hope that we'd continually be growing our GDP, our US gross domestic product, which is in layman's terms is a basic measure of the market value of all final goods and services made within the borders of the United States each year and sold. So if our GDP over time is decreasing due to the new tax plan, not only is that going to hurt American businesses, but it's also going to decrease the taxes made off of those businesses, because if they're decreasing the amount of goods sold, well, that's decreasing the amount of goods taxed. So that's going to be an interesting proponent that I think it's really important for us to, even though it's only 1.62%, which sounds small, when you consider you're hoping to grow, that is a significant that's a significant loss over time, because no country and no business is hoping to stay stagnant. So a loss is a pretty big deal, in my opinion. On a conventional basis, the Biden tax plan by 2030 would lead to about 7.7% less after-tax income for the top 1% of taxpayers, and about 1.9% decline in after-tax income for all taxpayers on average. So I know he said that he's not going to raise taxes on anyone that makes less than $400,000, but in reality, according to these professionals, the taxfoundation.org, and other analysts, in fact, the policies they would be putting in place would raise your taxes and would decrease your income. So, if you felt an increase in income due to President Trump's tax cuts, well, they're going to repeal those instantly, and then they're going to try to add more tax policies that would be raising taxes on not only corporations, but if you make over 400,000, and it sounds like they're also going to be decreasing your income even more, even if you make less than $400,000. So even though they're taxing the top 1% and those who make over $400,000 the most, they still are going to be taxing those who make less than $400,000 more than you currently are being taxed. So a couple plan highlights that we want to talk about is they're going to impose a 12.4% Social Security payroll tax for wages above $400,000 on top of the Social Security taxes we already pay. They want to increase corporate income taxes to 28%. President Trump cut corporate income tax rates to try to be more competitive worldwide. They want to re-raise those at 28%, which, from my perspective, I understand why they say they want to do it. I, again, just hope that by increasing our income taxes on corporations, that we aren't squeezing out jobs, right? So if we're increasing the taxes that corporations owe, and if they also mandate an increase in minimum wage rates to a flat $15 per hour across the country, regardless of what county or state you live in, it's possible, and what scares me a little bit there is it's possible that we're going to end up squeezing out jobs. And the people who are really going to be hurt are those low income or medium income earners that no longer have a job, because the corporation's number one priority is their bottom line. So if they have less money to spend on their employees and their employee benefits, they might just cut employees. They want to establish a corporate minimum tax on book income. They want to double the tax rate on the global intangible low tax income regulations. They want to temporarily increase the generosity of the child tax credit and dependent credit. So that could be helpful if you're having new children like I do. They want to increase that tax credit for you. So like I said, kind of going back to that, it's really interesting when you read through their total plan, how they want to raise taxes in almost all situations, but they're also adding more tax credits. So it's kind of interesting there. Conventional revenue, like I mentioned, from 2021 to 2030, they expect to make about $3.3 billion, or $3.3 trillion. Dynamic revenue, about $2.8 trillion. Their gross domestic product, as a review, would go down about 1.62%. And their capital stock would go down about 3.75%. And like I mentioned earlier, they estimate their full-time equivalent jobs would go down $542,000. So Over the next 10 years, the Joe Biden tax plan would actually project to lose 542,000 full-time jobs in the United States of America. So even though they're taxing those who still have a job more, they're going to create a job deficit of $542,000, which could be a really big deal if you are one of those people who lose your job, or if your job depends on other people having a job. So a couple more details to highlight. I'm not going to go through everything in here, but I'm just going to try to pick out some more things that I think could be valuable for you to know. We already talked about 12.4%. They want to revert the top individual income tax rate for all incomes above $400,000 from 37% up to 39.6%, which is the pre-tax rates that President Trump created when he cut from 39.6 to 37. When going back, the capital gains tax, so the taxes on long-term capital gains and qualified dividends at the ordinary income tax rates of 39.6%, that's almost doubling them, because currently capital income tax rates are 20% at maximum, and they want to put that up to 39.6%. So that could have a huge, huge impact on your wealth creation opportunities, as well as your retirement income if you are a business owner or real estate and things like that. They want to cap the tax benefit of itemized deductions to 28% of value for those earning over $400,000. They want to, I already talked about that. Talked about the child tax credit, a little more details on that. They want to expand the child tax and dependent tax credit. Expands the child and dependent care tax credit, CDCTC, from a maximum of $3,000 unqualified expenses to $8,000 qualified expenses per dependent, up to $16,000. And that's really the majority of it. From a personal standpoint, that's the majority of it. From a business standpoint, if you're a business owner and you stuck with me this far, they want to increase the corporate tax rate, like I said, from 21% to 28%. That's a 33% increase, 7% of 21%. They want to create a minimum tax on corporations with a book profits of $100 million or higher. They want to skip a couple of those things, unless you work in the global market, that's not going to pertain to you. Okay, and they also want to eliminate step-up in basis for capital gains taxation. All right, so what does that mean? Step-up in basis for capital gains taxation could be one of the biggest and most important things to understand, because if you own a business or if you own investments that you want to one day pass down to your children or gift to someone that you love, or your children, or whatever it may be, this could have a huge effect on your taxes and what they owe. All right, so they talk about eliminating the step up in basis for capital gains taxation. The cost basis of property transferred at death receives a step up in basis to its fair market value. This eliminates an heir's capital gains tax liability on appreciation in the property's value that occurred during the descendant's lifetime. So what that means is, if I buy a business for $1 million, and that's my basis, and then when I die, it's worth $2 million, and it goes to my children, their basis would step up to the $2 million mark. So that when they own the business, their basis is $2 million. And if they were to grow the business to $3 million and then they sell it, they'd owe taxes on that $1 million of growth from the time they own the property or the business. Now, if you eliminate that step up, their basis sticks to the $1 million that I originally paid. So the second I die and pass on that business to them, they would owe taxes on the capital gains of that million almost instantaneously, as well as anything they grow from there. So it's going to create a huge tax liability for any beneficiaries or descendants that are receiving businesses or other investments that are treated based off capital gains taxes. Property transferred before death receives a carryover basis, which means the donor's original cost basis is carried over to the recipient. This requires recipients to pay capital gains taxes on appreciation in the property's value that occurred during the donor's lifetime when they sell the property. All right, so that's directly when it comes to property itself, whether that's real estate and other things. Step up in basis discourages people from realizing capital gains. Eliminating the policy would encourage capital gains realization, right? So that's saying that you'd have to pay that capital gains tax, which is going to be basically doubling. It would increase federal revenue and remove a tax expenditure that would allow taxpayers to entirely exclude returns on saving from taxation. Repealing the step up in basis would make the tax code more neutral, they say, and eliminate a tax expenditure, but eliminating the policy would without changing the estate tax could increase the tax burden on capital and increase compliance burdens for taxpayers. Basically, like I said, saying that if you are receiving a business as a gift or inheritance from a loved one or a parent, it could dramatically increase your tax liability when they repeal or eliminate that step up in basis. So overall, that's kind of a highlight of the Democratic presidential nominee Joe Biden's tax plan. Like I said, kind of the key findings were they estimate to increase tax revenue over the next 10 years, but they also estimate to be decreasing the United States gross domestic product by 1.62%, and they also estimate to be losing about 542,000 jobs. So that please let me know if you have questions. Hopefully today's conversation was helpful. I know I threw out a ton of information. So I will include the link to the taxfoundation.org Joe Biden tax plan 2020 that I've been getting this information from on my post, whether you're looking at it through Facebook, YouTube, LinkedIn, or my Google business page, or any of the podcast platforms. I'll make sure to include the link in case you want to dive more into it. But if you don't want to read into it yourself and you want to just ask me questions, I always love hearing from those who take the time to watch and or listen to my my Money Not Math conversations. So please don't hesitate to reach out to me and let me know what you think or what questions you have. And as always, anyone who's willing to take the time to share my posts, I truly, truly do appreciate it, and it means the world to me. So thank you so much. I hope you found this conversation valuable, and I hope you have a great rest of your day. Thanks. Bye.